Hello, everyone. It's Kim Arthur from Main Management in San Francisco, and I've got my partner and colleague, James. How you doing, buddy?
Good to see you, Kim. How you doing?
Doing well, thank you. So we've got a little fourth quarter 25 macro pack outlook to talk about, and we'll try to keep it high level and, look forward to engaging in conversations with any of the advisors that want some more in-depth talk about it. So with that, let's just kind of go through some of the table stakes here. Again, main management, I like to remind people we are 25 team members, half of which have equity. So they are very much business owners. And we're closing in on 5 billion of AUMs, of which 15% is partners. So we are all very much aligned right with the clients. And I just like to remind people we like to build meaningful partnerships through trust and service. Next one here, you can see our investment team, which is 5 deep. The top 3 on that, myself, Dick Fredericks, and Jim Considine, we've been with the firm since the inception. So when you see strategies, composites, 60% of the team has been there, and we've filled it in with some great pieces. Our head of research, Alex Varner, and Daryl Ryan. All right. I always like to say costs matter, trust is key, price and proof rarely happen, and it's time in the market. Time in the market. Those are all very, very key pieces, beliefs. All right, James, let's take a quick look here at the asset classes. What can you kind of decipher from what happened in the third quarter?
Yeah, you had a kind of continue to rebound from the volatility earlier this year. If you look at the year-to-date scoreboard, something that stands out is definitely the international side. All of those top actually 5 indexes we have are international focused in one way or another. So in Q3, I think the S&P kind of was slightly ahead of international broadly, but on a year-to-date basis, international continues to be ahead, which I think talks a lot about the rebound that we've seen. International has been an under-owned asset class, and we get into this later, but not a lot of exposure there from at least the advisors that we're talking to.
Yeah, I was going to say it's back, but the problem is it's been gone for so long, nobody would know what you're talking about. So I like it. You have to kind of reintroduce the asset class, and we will definitely hit that a little bit later here too to go into depth. How about at the sector performance in the U.S. market?
Yeah, I think the big story this year has been led by these tech companies and AI kind of affiliated companies. So that's communication services with your Meta and your Google, your Infotech obviously has those big tech companies. Also, industrials and utilities are on the top of that kind of leaderboard year to date. Also affiliated with kind of the AI infrastructure build out, tariff affiliated. It's all those themes that you've probably been hearing over the past 9 or 10 months. It makes sense when you look at this kind of leaderboard.
Yeah, and what you can't see from this slide, but you and I have looked at this information technology, which is up 22%. The bulk of that has come from earnings. Earnings have been
hmm
explosive in IT. The S&P as a whole has had a little bit of multiple expansion in earnings that have been robust too, but
hmm
boy, IT continues to deliver, as does communications. Okay, I like this one. I know this is one that you have some fun with, the economic policy uncertainty. And, I look at your data boxes on the left-hand side that tell me, let's keep the uncertainty high, because when the uncertainty is high, you have almost 2x the total return. Can you maybe talk to us a little bit about why that is? And should we expect this to come down or remain elevated?
Yeah, and we've had this chart in the previous quarter, and I think even before that, it's looking at this index that we track, which is called the U.S. Economic Policy Uncertainty Index. And what it's doing, for some background, is it's looking at actually newspaper articles, and looking for kind of keywords that imply some sort of uncertainty around the economy or policy or legislation. And that kind of combination of keywords you're able to look back at it over time, 50 to, even back to like the 50s, I think. So 70 years, and really see over time what this uncertainty looks like. In April, this reached kind of an all-time high, even higher than COVID among the Liberation Day and tariffs, and all of that trade policy uncertainty. You've seen some retreat back. Uh, it's kind of been spikily coming back down, obviously, as the headlines continue to come out every now and again, whether it's China or Canada or like you see almost one every month. And then also the government shutdown, like these all add to that kind of economic policy uncertainty. But it is lower than it was when it peaked in April. And as you mentioned, when you look at these historical peaks or even times when it's kind of above its +1 standard deviation, in other words, kind of above its normal range, you do see stronger than normal forward returns for the S&P 500. I think when you look back at you can kind of see where those periods are. It's periods like, COVID, like
Yeah.
2001, like these kind of previous periods where there was a lot of uncertainty, people were worried, things were unclear, and usually that's a good indication to be buying equities where things are unclear. So we see that as a, same story nowadays.
Yeah, I like to say, as we said earlier, we gave you our 4 beliefs, and one of them was price and proof.
Mhm.
This is a perfect example because most people would see those spikes and say, "I wanna run
Yep.
for the exits," but typically when it's spiked that high, that means it's discounted all the bad news. It's very similar to an elevated VIX for the listeners, that are used to the VIX, the VIX, the volatility index. When that spikes to very high levels, you wanna go in there and buy. So price and proof, good things. Okay, market bubble and AI. This is very timely. Meta just put its earnings out on the tape, and one of the headlines said that the 2026 CapEx will be significantly greater than 2025. You can see the composite for all these hyperscalers. You've got it down here at 366 billion for this year, going up by about $80 billion for next
Mhm.
year. These are big numbers. Do you think we have a bubble in AI CapEx, or do you think that these guys are smart enough to realize that they got to spend in that area?
Yeah, it's definitely one of those things, like, they feel the pressure to spend because they look around at these other hyperscalers, these big tech companies, and everyone else is doing it, and if they don't do it, they could be left for dead, if they don't have this kind of next stage of AI growth, and that's something that a lot of these executives have said, like, this is a do or die kind of moment. I think in terms of what it's actually causing, uh so far, this ROI so the ROI on this spending has been worth it. A lot of it too is coming from their actual cash flow.
Right.
These companies are very, very, very profitable, some of the most kind of largest free cash flow companies in the world.
Yeah.
So they're able to finance this using a lot of that existing free cash flow. You're starting to see some kind of private credit, private deals, but it's still early days there. But the numbers, as you mentioned, are absolutely massive at, hundreds of billions of dollars. It's on a dollar basis, the largest kind of infrastructure project build out, probably in US history or, at least in
Yeah.
the last kind of post World War II. So it's actually very, very astounding on how much money is flowing into this space.
Yeah, and as you pointed out, for those of you listeners that were not around in the late 90s when they were building out the infrastructure for the internet, um, there was a key feature that was different. As James said, these big hyperscalers are using cash flow. Now, they are adding some debt to their balance sheet, but they still have cash flow. Back in the late 90s, there were a lot of companies, they had to go to the high yield market because they did not have the cash flow. So their debt adding was high yield, and a lot of it went to zero, went to absolute zero. So that is a big key feature difference. All right, fiscal policy tailwinds here. This one is very near and dear to me. For those of you that can't see, if you're just listening, there's a picture here of the effective corporate tax rate going back to the early 80s when it was up at 35%. And this is a slope line going down. And with the new One Big Beautiful Bill with 100% expensing of CapEx, the effective corporate tax rate next year is going to be 10 points. It has never been that low, never been that low. And this is going to drive a lot of business activity. Simple things like factories that used to be 39 years of depreciation over a straight line, it's 100%. R&D, 100%. Equipment purchase, 100%.
Mhm.
I mean, this is gonna be powerful, powerful, and it's one of the things that we think GDP will get a pickup next year versus this year. It's interesting, Powell in his press conference today for cutting 25 basis points, he also pointed out that GDP right now in the second half of the year is actually picking up, and that's because this, effective, expensing is already in effect right now. Um, all right. Federal Reserve. We had them cut rates 25 basis points. We're at 3.875. Um, in Powell kind of he didn't close the door for December, but he
Mhm.
said that December is still data dependent.
Mhm.
Where do you think we're going to be at the end of the year for the Fed fund rates, and then where we'll be 12 months from now?
Yeah, it's a good question, and after today, it's a bigger question mark. I think before today was kind of everyone thought, December was basically a lock on another 25 basis point cut, but clearly there's some uncertainty there based on what happens in the broader economy and kind of how things pan out. Clearly, if you look at the US 2-year yield, that's something that we look at as kind of a proxy for where markets think the Fed funds is going. That implies a little fewer rate cuts than if you look at just the Fed funds futures, which is a different kind of market, different way of looking at it. Overall, I think maybe there's one more in December. It doesn't seem like the environment kind of necessitates cuts. The economy is kind of doing fine. There's some weakness in the labor market, and that we'll get into on especially the younger cohort. There's obviously the AI build out, which is contributing to GDP. There's the fiscal tailwinds contributing to GDP. So it's a kind of a hard environment to say, yeah, we need a bunch of emergency cuts. But if the labor market does kind of deteriorate faster, you could see that being used as kind of a rationale behind that.
Yeah, that makes sense. In the next slide, you'll see we'll kind of hit the labor market. Obviously, the Fed has a dual mandate. They've got full employment and stable prices. Stable prices are the inflation. Powell mentioned today that in the labor market that the demand for labor is dropping, but so is the supply. We've talked about how the borders are sealed right now, so there are some estimates out there that you only need 25,000 jobs per month to maintain the unemployment rate at 4.3%. So I think to your earlier point there, GDP is clearly does not warrant a rate cut. But they are watching that unemployment rate. And again, given how low the hurdle rate is, that's why December is sort of like it's a toss up. And he also pointed out, and I know you and your team do a great job with this. The government statistics have been shut down, but there are so many private statistics that are
Mhm.
available that you can reverse engineer thing. One of the things people have been looking at the claims, which you can see on this chart here. If you look at the claims, they have not spiked here since the government has been shut. Those they're still getting information on. So all right, what do we got on the next one here? Youth unemployment. I'm along 5 kids. I've got some that are they're none of them are right in the cohort that you break out 20 to
Mhm.
24 here. I've got them bookended above and below that. But for those of you again that can't see this, right around 22, when Chat GPT came out, the youth unemployment from the age 20 to 24 was 5 and change. It's now 9 and change. Most of the other cohorts have not moved up. They've been flat. We think that there's two pieces to this. One is the fact that AI is definitely an alternative, but this is something that we talked to some people at BlackRock, and they have a much bigger sample size than we have here. But a lot of the youth that were in college during COVID, I think, unfortunately, COVID really was a detriment, a headwind for them because they didn't have adult supervision. So they kind of lost that focus and purpose. And we saw that with cohorts when we were looking to hire in 23, 24. the pool of applicants it wasn't as good as it should be. I will say that for 25, it looks a lot better, and BlackRock kinda confirmed that. Did you hear anything else from them?
Yeah, I think they definitely confirmed that. It seems like the kids are back.
I like it.
They're the passion and the willingness to work is definitely there. I think there is kind of risks. I mean, you can see this kind of gold yellow line moving up. Certainly, that's from a firm perspective. Maybe there's uncertainty. Even if AI isn't replacing those jobs today, it's I don't want to have to train this person for a year or 2 years or 3 years. If there's some sort of AI system that can replicate that job in the future, it's like it's funny. It's not even the AI taking the job. It's like the uncertainty or idea of AI taking that job, or maybe making that job less relevant. So,
Yeah. Now, one area we know that AI is not going to impact as much is if you look in the trades, whether it is HVAC,
mhm,
whether it's plumbing, whether it's electricians, there are a lot of unfilled jobs in those areas.
definitely.
Okay, inflation. Powell, again, his favored measure to look at is the PCE, which we have through the end of September, and it's 2.8%. The core that takes out food and energy is also at 2.8%. So again, it's not 2%. Remember, 2% is really an aspirational goal. But at 2.8, it's kind of stuck. And he mentioned too that clearly non-tariff items are still seeing some declines.
Hmm.
The tariff items are seeing some increases, and then service, where there had been disinflation, there is a little worry around there because that's much more labor intensive. But any other thoughts that you have around the inflation fronts?
Yeah, it seems like if you look under the covers, as you were saying, you're getting kind of disinflation in the non-tariff items, inflation in some of the tariff items, and overall, it's kind of offsetting each other. I've talked about this before, but kind of it's almost as if, if people are spending more on these tariff impacted goods like their car or their, clothing or whatever they're importing, that just naturally makes them spend less on their non-tariff impacted services. So it's kind of like this offsetting effect where the overall inflation level is the same
Yeah.
or relatively unchanged. But if you look under the covers, maybe you can see certain things.
Yeah, that's a great point. There's also, I'd point out, Schwab had a piece this week where they have a basket of tariff items. And
Hmm.
we've been pretty consistent about this internally here that tariffs are taxes. Taxes are demand destruction, or they cause substitution effects. And Schwab has been, looking at their basket of tariff items, and they're seeing exactly that, that there's demand destruction and or substitution. Now, sometimes there are no substitution effects, but I will say that the administration, when there's groups that have gone and lobbied them, if there are categories that have tariffs on where there aren't substitutes available here, they've backtracked pretty quickly.
Hmm.
Um, all right, we got inflation driver. This is oil. Oil year to date is down about 17%. The price at the pump is always runs on a different mechanism, but it's about $3 a gallon right now, and it's down year over year from 313. What else can you glean from this?
Yeah, I mean, it's obviously a huge driver of all sorts of prices, commodity prices. All of those inputs are very, very much tied to oil. It was one of the things that caused the inflation spike in 2022 is the oil inflation driving a lot of that. So, from a inflation perspective, it's good to see it coming down. It certainly has some implications going forward of, less pressure on the kind of upside for inflation.
Yeah, and it's kind of in big buckets. This isn't on this slide, but there's 5 big drivers for 26 would be oil down, check, we've got it. Regulations down, check, that's from the one big beautiful bill. The 100% expensing, which is very, very, very key. That's also down. And then there's some ad hoc pieces with cuts in tips. Some portion of that won't be taxed. Social Security, some portion won't be taxed. Auto loans will get preferential interest deduction. All of that in aggregate's like a couple $100 billion
Mhm.
that goes into increased consumer disposable income. Okay, why don't you take us in? This is the fourth year of a bull market that we're in as of about 2, 3 weeks ago.
Mhm.
What do we have to look forward to?
Yeah, so October 12th, if you remember all the way back, October 12th, 2022, the market bottomed, and since then, you kind of had this bull market for the past 3+ years, now entering the fourth year. This chart looks specifically at previous bull markets and kind of what the average sort of path looks like. You can see over the course of the past 3 years, the first year from, that October 12th, 2022, when it started, that first year was kind of under the average path. The next year was above the average path. Last year, you saw some kind of intra-year volatility in March and April, but it has kind of ended up roughly in the realm of what you'd expect. The fourth year of a bull market tends to be relatively strong. Obviously, this is a small sample size, but a sample size of 8 other bull markets, you saw a 17% average return for this kind of fourth year with smaller or lower than kind of typical drawdowns. So it's one signal to look at. It's one data point to look at. It does imply stronger forward returns. Um, but we're entering a fourth year, and that tends to be good.
And as we've said before, we'll remind people it's this cycle of the bull market, you need earnings.
Hmm.
We mentioned technology with their earnings in high 20% range year to date or year over year. And we think that you'll probably see this double digit earnings growth for the market that's happened this year, and we are estimating that that'll be the case for next year.
Yep.
Okay, credit spreads, just quickly on this one, typically for listeners, the tighter the spreads, it typically means the less likely there is a chance of a recession. There's some other things going on in this one, but again, this is one of the things where we use it. You cannot use it just in isolation. But because what happened is these spreads spiked in April when people were fearful that that was a crisis that was brewing because of the tariffs, and it turned out to just be a correction. But something to keep in mind here that they're very narrow right now, but that means that there's a low likelihood of a recession going.
I will say, just adding on to that, they've become, because the spreads are so narrow, they've become just less attractive as an asset class, where you're basically getting, just barely over, 2 to 3% more than investment grade. So when people are trying to boost their income, that's been a time where our buy right strategy has
Yeah,
come up. It's a different kind of um, wrapper, a different flavor than high yield, but it serves a similar purpose of kind of giving that income, giving something that's above just investment grade.
that's right. Not only do we have the yield, but we can actively manage some levers to even, give you some protection in a down tape there where high yield only has the yield
Yep,
portion of it.
yep.
Mortgage rates. This is obviously we, created this slide pack a couple weeks ago or in process, and it's interesting. It shows the 30-year effective rate at 6.4, let's say. It's down to about 6.2 right now. So rates have come down here. I would point out that the housing sector is an important sector, but we think again for 26 that it's going to be much more about CapEx because of the bill and infrastructure onshoring. And you look at CapEx, CapEx is like 7 times the size of the housing new construction industry. So that could be very, very interesting. But this also, if we continue to get rates to come down, we don't think they're coming down a heck of a lot more. But that could be a tailwind. All right, gold. Since this came together here, we've had a 10% correction
Mhm.
off of that. And it's actually, I look back the last 3 years, this is the biggest correction. It's about time we've had a
Yeah.
10% correction because this thing looks parabolic.
Yeah.
Anything you want to tell us why this thing is done what it has and what it might be doing going forward?
Yeah, I mean, the first thing I'll say is when you do go parabolic like this, it's up, 100% in under 2 years. Those types of corrections in any asset class are not unusual. So I think you kind of have to be able to handle that volatility if you're up 100% in only 2 years. But in terms of kind of the drivers and why we've seen this be the case. A lot of it is due to central bank buying outside of the US, which a lot of this is a kind of move away from these central banks from the US dollar, or at least a
Yep.
diversification away from it, which is kind of this broader macro move, which has been just kind of continuing for years now, and it's kind of accelerated into this year. There has been some retail speculation, especially if you're looking in, silver or some of the other precious metals. But in terms of gold, it's kind of this long-term macro uh, tailwind.
Yeah, to your point there, when Russia invaded Ukraine, if you looked at gold as a percent of global central bank reserves, it was about 10%. It's now 15. Now, if you go way back to when, all the central bank, well, the U.S. was on the gold standard, those numbers were oh,
Yeah.
70%. But in modern times, you're exactly right. There is a mix shift that is happening. So from that standpoint, you could have a continued movement in that direction.
Right. And it's funny if you look at that. I've also looked at that kind of percent of central bank assets. Obviously, some of it is buying and purchase of gold, but some of it also is just the appreciation.
Big time.
Where where your dollar is not moving, or it's kind of even depreciated, and your gold is again gone up 100%. So certainly some dynamics there.
Yeah, one other one, not to drive it dead here, but India is obviously known for they like to own gold. A lot of it's jewelry. But if you look over the last couple years, to your point, to have this thing have gone up 100% in pricing, they've got a wealth effect
Hmm.
that's
Yeah,
kicking in for sure.
yeah. There's a lot of consumer ownership or demand of gold there.
Yeah, definitely. Okay, the dollar, the dollar had the notorious 10% drop the first 3 months of the
Hmm.
year is one of the biggest single quarter declines that we've seen, but it's basically flatlined for the
Yeah.
last 6 months.
Yeah, it definitely has kind of flatlined here after many calls that it would continue to weaken. One thing that we watch, especially for the dollar, it obviously is tied to international equities,
Yeah,
where if the dollar is depreciating, international equities naturally do better. One of the things to see is that even as the dollar has flatlined, international equities have continued to do well, which to us is saying that it's not just a currency story. There's more to it than that. There's a kind of re-rating. There are very depressed valuations. There is growth there on the earnings front, which we'll talk about on the next slide. But there's definitely some opportunity outside of just kind of the currency play there.
yeah, it's a good point there. The earnings are starting to kick in. And with that, this picture here shows on the top of the horizontal line there with the blue circles there. We've got 4, and the fifth one is just starting on the far right here. It looks to me, James, that when we get a cycle, if it really kind of gets some tailwind behind it there,
Mhm.
that there's multiple years of that asset class to outperform the S&P.
Yeah, I mean, you could see back in 70s, 80s, 90s, you went back and forth between US international outperformance and as you're saying, the cycles were multiple years. It wasn't kind of a 1 or 2 quarter thing. So when you start to see this outperformance, you saw it briefly a couple of years ago, you're seeing it now again today. It makes you raises some eyebrows to say, is this the start of another cycle that we haven't seen in quite a long time, in almost 15 years.
Yeah. And we have, the closest proxy is large cap US value. The reason why, if you look at just the developed markets overseas, their tech weighting is 8.5%.
Mhm.
The S&P, you got to go back to 1995, the last time the S&P only had tech at 8.5%. The tech portion right now is closer to 35% in the US. Emerging markets are up at that 30% level. So they look a little more like the US
Mhm.
does. But the point being that the strategies, we've got an international strategy and it trades at just over 14 times, where US large value is 18 times,
Yep.
18 times. Those two should be on top of each other. And if the earnings, which a lot of it's going to be driven by the emerging markets here, the earnings should be up 10+% next year, just like the US. So to your earlier point, you get a potential PE expansion and you get the earnings. So that's nice.
Yeah, and just speaking on earnings for a second, this is a chart looking at emerging markets, developed markets, and then the broad, just all country world, ex-US. You can see that the earnings growth is coming a lot of it's coming from that EM exposure, and that's where we have overweights in our international strategies in that EM area, in kind of specific countries. So that's clearly where some of the earnings growth is going to come from. That ultimately will drive kind of valuations hopefully higher.
Yeah, that's a great point. And again, if you overlaid the US on here, you'd see the US would live right where, the EFA is there. It'd be 10% or something, be
Mhm.
somewhere around there. Okay, what's this spaghetti
Yeah.
telling us here?
So this is a way of looking at the kind of quarterly earnings for the S&P, what the revisions are over time. We're in the middle of earnings season right now, as you mentioned, the Meta earnings just today that came out, along with Microsoft and Google. Um, so one of the things to look at for this is you saw in Q1 and in Q2 earnings were better than expected. It's that the orange line and the red line went from roughly kind of 5 to 7% expected at the start of the earnings season. It ended up being around 12 to 13%
Yeah.
realized. This time around for Q3 2025, expecting 8.5% earnings growth. So we'll see what happens. It's kind of just in the middle of it right now, but if that trend continues, you could see a beat here. One thing I'll say as well, I mean, this overall chart just shows how strong earnings have been and why one of the reasons why the market has done well, it's been that earnings-driven growth. You've seen that just every quarter just continuing to jump higher, beating expectations. So that's something to keep an eye on. It's not so much, sentiment or froth or all of that. There actually is some basis in reality for, the performance here.
Yeah, and it'll be interesting. The scorecard so far is low double digits
Mhm,
for the third quarter versus what you mentioned, 8.4%. So we're getting it again. The fourth quarter, we get another kind of, I call it an easy comparison,
mhm,
but it's 7.5%, and will probably be double digits. Now, what's going to be interesting is in the first quarter,
mhm.
the bogey is already set at up 12.
Yep.
So you got some more difficult comparisons, and sometimes that's where the market, there may, again, markets typically will give you a correction, a peak to trough intra-year of low double digits. Who knows? Maybe that will
Mhm,
be it there where the market will say, "Wow, the bogey was too high." It still delivers on that part there, but it kind of gives a buying opportunity for the rest of it.
mhm.
Okay, what do we have on our recession watch? I see lots of blue and a couple green.
Yeah, I think largely, I mean, there's no red flags
Yep.
out there, so to speak. Typically or kind of across the board, relatively neutral with some positive signals in both PMIs, kind of the manufacturing and services, and also retail sales. So that's just the consumer, how strong they've been. I think it is good to see that there's not really any sort of, again, red flags on the horizon there.
Inflation, you've got it as blue. If in fact we see that these tariffs kind of caused a one-time
Yeah.
stall, is there a chance you take that to green next year?
I think so, especially, I mean, we talked about it earlier. The oil is one of those drivers.
Mm,
Tariffs are that uncertainty. They've so far seen not much of an impact. It's hard to say going forward. It feels like you kind of got over that initial hump.
yep,
Doesn't really seem like there's all that much now to push inflation higher. So I think the next kind of leg down would probably be green.
yep. Okay. Price range here. So the market is roughly 6,900. So the 7,500 for next year is total return, including the dividends, is up about 10%. The downside, if you throw the dividend in on that, down about 7. Obviously, we usually like to see something more 2 to 1 ish. But there's nothing wrong with that sort of ratio there. But clearly, as we mentioned, we do think a feature of markets is that intra-year peak to trough,
Hmm.
10, 11, 12%, that should be used as an opportunity.
Hmm. I will say too, it's so dependent on earnings here, where
Yeah.
if you have continued kind of strength in earnings season, continued revisions up, it could grow into that multiple, grow
Yep.
into that price range and even go higher, but that's so dependent on kind of what happens here.
Yeah, you are right about that. There's a school of thought out there that the margins keep going up. We've talked about this in other podcasts where in 2000 the market's margins were about 7%.
Mhm.
They're close to 14 today. And if that continues to keep going higher with productivity and with more efficient and
Mhm.
better operations, et cetera, more use of technology, you could argue that maybe the multiple would go, creep up a little bit higher. We're not saying that's our base case, but we're just pointing that out.
Also, the less cyclical composition of the
Yeah,
market where, you for hundreds of years, the market was made up of, like, railroads and
yeah,
industrial factories where that's extremely cyclical and sensitive to economic drawdowns. The companies in the kind of the largest companies in the index today are much less of that traditional cyclical kind of makeup.
yeah. And I like to remind people too, if you look over the past 100 years, there's less than 4% of the publicly traded companies that have contributed 100% of the returns. Let that sink in for a minute there. Over 100 years, less than 4% of all the companies have contributed 100% of the returns. That means that by definition, you have a handful of powerhouses, a handful of powerhouses. So when people get all worried about the Mag 7 and think, oh, we've never been there before, actually, it's not that unusual.
Mhm.
So that's one of the reasons why we think it's so important to the strategies that we have. We've got diversification across sectors and individual companies that allow us to capture those big super contributors. So all right. Well, with that, I think that's all we have. Again, we really want to thank everybody for the partnership, the meaningful partnership that you have with Main Management. And we are, two rings, no waiting. Anything that we can do to help you out, all the team members are available. James, any closing comments?
Oh, yeah, we appreciate the partnership, and our line is open.
Awesome. Thank you guys very much.